I think maybe this is a good time. So first of all, let me just say welcome and thank you for joining us. We're very excited to share a few thoughts with you as always. Before we do anything else, I'm going to ask Yusuf to give us an overview, and we have a fun quiz that we'd like you to take as well.
Exactly right. Thank you, Dave. And so taking a look at today's agenda, 5 items here. We're going to be doing a comparative performance review, seeing what's been happening in financial markets and having a discussion to contextualize what we've been seeing and talk about how it's been affecting our clients and their portfolios. From there, we'll pivot to a discussion about the labor market. No shortage of news, headlines being printed about the job market, unemployment rate, how that's affecting the economy. We'll have some thoughts there. We'll then talk about inflation and interest rates, because it's not a webinar unless we talk about inflation and interest rates these days. We'll have a few comments there. We will certainly check in with respect to the recent banking scare. We'll have some thoughts around recent events. And we'll certainly talk about how our clients' assets are protected. And then we'll close with our outlook for the second quarter of 2023 and beyond. But before we dive in, as David mentioned, we've got a few poll questions that we've put together for today, just to get a sense of where our audience is. So starting with number 1, what is your current assessment of the market or the economy? Single choice here, and there are no wrong answers. So go with your gut. Responses coming in mixed, anywhere from good to terrible.
No, don't make it worse than it is. Only good to poor.
Excuse me. I should have scrolled. That's right. And thankfully, no one's picked the end of the world yet. Thanks for managing the polls, Lauren.
All right, we'll give this one 5 more seconds. We've got about 80% responding so far.
And half of you think the economy is doing okay.
Yeah, so I'll go ahead and share the results of that one so everyone can see. Yeah, about 47% are with okay. Got another 30% looking up or good, and 23% poor. So I'll stop that one and we can go. Want to go to number 2, Yusuf?
Yeah, please.
All right, here it comes.
So in which direction is inflation trending? Let's see if you all have been watching the news.
All over the map here.
Oh, less so all of a sudden.
All right, we'll give this one about 5 more seconds. We've got about 80% responding. Okay. How'd they do, Yusuf?
Well, we won't belabor the point here, but inflation is trending downward, and we'll have some more stats to back that up and share more about that as we go through.
All right, on to number 3.
Is the stock market up or down year to date? How are stocks performing?
These are some good teasers for what we're going to hear about today.
Indeed.
All right, give this one 5 more seconds. Okay, and I'll share those with everyone. Got about over 50% said flat, 38% shared up, and 9% think down.
Well, if you voted up, you're right.
All right, we
But more
got
to
2
come there.
Yeah, 2 left. This is number 4.
How's the bond market performing? up or down, or flat?
And of course, these are interesting for us to see because we don't just think about these things every day. I'm going to say, quite honestly, we sort of obsess about them every day. But, you know, that's our job, so that's okay.
All right, give this one just 2 more seconds. Got even
Evenly distributed.
responses. Yeah, even responses for down and flat there, about 40% each, and 24% think up. We're not going to share the teaser answer for that one. We'll get to it. And final question here, number 5, Yusuf.
Just getting a sense from our audience, what are you most looking forward to hearing about today in terms of the agenda that we've laid out, whether it's performance, inflation, interest rates, the labor market, commentary on the banking scare, outlook for Q2 and beyond, Dave's stories that relate to all of the above. What are you most interested in hearing about?
And of course, I'm just going to disclose right up front, no matter what you're most interested in, you're going to hear about all of these things. So,
That's right.
And you will definitely get the Dave stories.
No doubt.
All right, so I'll go ahead and end this one and share the results. A lot of people looking forward to the outlook, a good number looking forward to Dave's stories, banking scare, market performance, and inflation.
Very good. Thank you, Lauren. And so as we promised, Dave, we'll start with your thoughts. Give us a sense of how things have been going from a big picture standpoint, please.
Well, you know, this chart represents what the markets have done since the beginning of last year, or you can see at the bottom left, the end of 2021, beginning of 2022, but basically since the beginning of last year. And you know, this is something you all experienced. I mean, it's hard to miss when the markets decline for the first 9 months of the year. You know, we've had a bit of a rebound since then, but as you know, longtime listeners, longtime clients, you know that we always paid very much attention to what's going on in the here and now, in the markets, in the world, whether it's politics, the economy, your investments. But we always try and place that in a larger context. And so if we take what's happened since the beginning of last year and we place it in a larger context, this is what you see. And the box on the right indicates the area covered by that first slide, you know, the period since the beginning of last year. And as you can see, there's 2 things to note here. One is that if you start at the beginning, this is, you know, 27, 28 years ago, if you begin at the beginning of this, oh, and by the way, I should say, this represents the aggregate of all of our client portfolios over the last 27, 28 years, and the performance of the aggregate of all client portfolios over that period of time. And there's 2 things to note. One, there's a lot of ups and downs along the way. You know, there's a lot of zigging and zagging going on here. And that's very much the nature of the beast, as you've heard us say before. But the other thing to notice is that, you know, the cumulative returns have you know, they've added up to something that's 7 times bigger than it was at the beginning. You know, we've gone from a value of 100, we sort of normalized on 100, treated the performance like an index, and it's gone from 100 to 700 over that time, notwithstanding all the ups and downs, because it's always something. You know, the markets are reacting to what's going on in the world day by day, and here we go. And go ahead and give me the markers there, Yusuf. There we go. And so, you know, I thought we'd take a little walk down memory lane. I mean, I lived through all of these with many of you who are with us today. And so I just thought we take that walk down memory lane. I mean, if we look at number one, that was the dot-com meltdown. And of course, that started in the year 2000, and it actually went through. It actually went to the beginning of 2003, and along the way we had 9/11. So it was a very tumultuous period with the meltdown of the tech sector, the popping of the dot-com bubble, and then followed hard on by the terrorist attacks of 9/11. It was a rough spot, but as you can see from the beginning of 2003, things took off again. Until we hit the Great Recession, which is number two. And the Great Recession was due to a whole host of factors. Some people have called it the real estate bubble because there was a huge inflation in real estate values that was driven by some, I'm going to put it gently, some innovations in real estate finance, in mortgage finance. But that was a major downturn. And it was, and in its suddenness, it was even more shocking than the dot-com meltdown. But we climbed out of that. And then we had another dip for the Greek debt crisis. That's number three. And then we climbed out of that. And then we had yet another dip. That's number four for the debt ceiling crisis. Those of you who are reading the paper every day know that this is a recurring theme, and we're potentially facing a debt ceiling crisis again. Although the other thing you may have noticed is that the markets don't seem all that alarmed by it. I think that to a significant degree, I think the markets are operating sort of in the framework of what Winston Churchill said about the Americans during World War II. I think the markets are saying the same thing about decision makers in Washington, D.C. They can always be counted on to do the right thing after they've exhausted every other possibility. We professionally believe they're going to get through this, that it's going to be a bit of a cliffhanger, but that we don't believe the U.S. is going to default on its obligations. We think this will be resolved, hopefully without a dip in the markets the way we had back in 2011. So the next one, number five, that's a China slowdown. The China is a major, is a major economic force in the world, as we all know. And there was real concerns about the Chinese economy slowing down, and to some degree that was driven by the fact that China had invested heavily in infrastructure in order to kind of bridge its way through the Great Recession. But by many economic and economists' estimates, it had overinvested. And when you overinvest in infrastructure, you actually lower the potential return of an economy. And China looked like it was slowing down. And that, of course, can be a force for growth in the global economy. So that was a concern. The next one, number six, was when we had a global slowdown or fears of a global slowdown. And that was accompanied by also concerns about Federal Reserve raising rates, because the Federal Reserve had started to raise rates at that time. And then finally, the last one, or the last one before last year, number seven, was the COVID meltdown. And this is one that was quite shocking in its suddenness. I mean, a third or more of the U.S. economy shut down. This was a true worldwide. And so unemployment rates soared more than we had seen in such a short period of time ever, maybe except since the 1929 and the Great Depression. Amazingly, none of us here at Yeski Buoy believed this was going to be the case. We climbed out of that before the end of 2020, and the markets actually ended 2020 higher than where they began. So that was pretty amazing. This most recent downturn that's now encompassed in the red box that we've mostly experienced last year, in some ways we've been thinking of that as the second leg of the COVID downturn. Because after the rapid recovery, what happened was we had two things that happened. We continued to have a significant disruption in our supply chains worldwide that were a carryover from COVID. So it created inflationary effects. If you have a lot of dollars chasing too few goods because the goods either aren't being manufactured due to lack of inputs, or they can't get here because there aren't enough there aren't enough container ships to bring them to our shores, then those too many dollars chasing too few goods drive up prices. We also, starting in March of last year, had the Russian invasion of Ukraine, which in the short run drove up energy prices, drove up food prices. They added to the inflationary pressures. So the combination of a spike in inflation and then the Federal Reserve reaction to that by raising short-term interest rates caused this sort of what we're calling the second leg of the COVID downturn. Now, interestingly, as we discussed in our last webinar, the world is an adaptive place. You know, we always talk about human beings as being resilient and adaptive, and human beings were resilient and adaptive, and they overcame the disruptions of the Ukraine war, and energy prices actually ended last year lower than where they started, and food prices ended last year lower than when they started. So human beings kind of adapted their way around that. But there are still some lingering issues, and I'm now going to kick it back to Yusuf to take us on a bit of a tour through some of those lingering issues.
Before we talk about the issues, we'll give you a bit more detail on performance, just to give you a sense of, you know, on a deeper level, how things have been unfolding in financial markets. We'll note that we're showing you performance over the past 6 months, so fourth quarter of 2022 and the first quarter of 2023. It's important to note that from peak to trough, so if you take your mind back to the initial slide that we showed you, from markets at their height at the beginning of 2022 through their bottom, which was at the end, when things bottomed out, I should say, which was at the end of September of last year, we were ahead of our benchmarks. We outperformed the All Country World Index by nearly 3 full percentage points, and that's our benchmark. We also show a couple of other indices here on this slide, outperformed all three. Then we're charting performance on this particular slide from market bottom, from that end of September through the end of this first quarter of this year. And you can see, you know, the SQ Buoy portfolio up, call it 18%, slightly ahead of our benchmark here, the All Country World Index, which captures stock performance around the world, ahead of the S&P 500, 500 of the largest companies in the U.S., trailing the All Country World Index, hence the title for the slide, international stocks.
Trailing the All Country World Index ex-US.
Excuse me. Thank you, Dave. There's the X there at the end of that ticker, ACWX, All Country World Index ex-US. So the story here is international stocks have been outperforming stocks in the US over the past 6 months, an interesting trend. As we dive in even further into more detail, what you can see on this slide are the actual individual investments on the stock side of the portfolio that are held in our clients' accounts. And what do you see at the top? International, 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 international. We're always gratified to see, by the way, when value stocks are at the top, we tilt the portfolio in favor of value stocks. And we're always happy to see when small company stocks are outperforming their larger counterparts. And so a lot of really encouraging trends as we see the value premium in display, the small company premium in display. And that's just extra expected returns over time that one can expect to receive by way of investing in either value stocks or small company stocks. It's a risk and return relationship, a little bit higher risk, and then you're rewarded commensurately by investing in those positions. And so we have a portfolio that's tilted in favor of those aspects of financial markets, and always happy to see when those aspects are performing better. And then moving on to bonds, and I think we buried the lead here, but on purpose. We didn't want to give away all of our thunder here at the top of the presentation. Bonds have been performing well over the past 6 months as well. The 4 different bond mutual funds that we use in our clients' accounts are captured here on this slide. Over the past 6 months, they're all positive. Year to date, they're all positive. And so, again, happy to see that things seem to be stabilizing in the bond market as well. And it's important to note why we're looking at the past 6 months. You know, inflation peaked last summer, and kind of the struggles that we were seeing in financial markets seem to have bottomed out again at the end of September. And so looking at the slice of time since then and observing the trends, they've all been quite encouraging. We included this slide just to provide space for us to make some comments about why we're not just throwing all of our clients' money into treasuries rather than using the bond mutual funds that we employ in our clients' portfolios. If you've been paying attention, you've noticed, the yields on treasuries are anywhere between 4 and 5%. Short-term treasuries are actually returning more than long-term treasuries. So if you loan money to the U.S. government, you actually stand to gain more by doing a short-term loan, 6 months, a year, and you'd have a return of close to 4 or 5%. Whereas a 10-year loan to the U.S. government in the form of a treasury bill or a bond, we're in what's called right now an inverted yield curve. The yields on those longer-term bonds are right now lower than shorter-term bonds. So we've been getting a lot of questions as to, well, why not just go into treasuries? They're guaranteed. You're able to get a guaranteed return off of that loan. Thing about it is the interest rate landscape is not done evolving, and as interest rates change, yields on bonds change. So if you're locked into a static agreement, a loan, a treasury bill is a static agreement. As interest rates change, you might find yourself locked into a loan to the U.S. government that is less attractive as the environment continues to evolve. Whereas we think being invested in a mutual fund, like one of the ones that we employ in our clients' accounts, gives you a bit more dynamism. Because the fund managers are actively seeking to manage those portfolios to maximize the yield and work the yield curve, as it were. What they have been doing in response to an inverted yield curve, where you're getting more return at the shorter end of the curve, is actually shortening maturities within these funds. So we'll pick on the 5-year global fixed income fund here at the top. As of March 31st, the average maturity for this fund, billed as a 5-year fund, is 1.3 years. And that's down from just last month. The average maturity for the same fund was closer to 2 years. It was at 1.85. The same is true for any of these other funds that we're looking at. Global Core Plus, down from an average maturity of 9 years to 7.4. The 1-year fixed, down from an average maturity of 0.9 to 0.64. And you can see that the yields to maturity here are actually competitive or better than what you could get from being invested in a treasury bill. And so, that was a bit wonky, but wanted to make sure that we presented the case for why we're using the mutual funds that we use. It's with intent. We're fully aware of the yields that are available by being invested in treasuries, and we're confident in the way that the funds that we employ for our clients, confident in the way that they're being managed, and gratified to see that the fund managers are working diligently within the context of what we're seeing, in the overall economic environment to maximize yield going forward.
And I think there's, sorry, go ahead.
No, I was going to kick it to you, Dave, before we go to the next topic.
Well, and I was just going to say, you were talking about the yield curve, and I think it's worth noting that the yield curve, the shape of the yield curve contains information about expectations for the future. The short end of the yield curve, as Yusuf noted, is higher than the long end. Well, one of the things that tells us is we know that the short end is being pushed up by the Federal Reserve. The Federal Reserve controls short-term interest rates, and they've been pushing short-term interest rates up in order to cool the economy and hopefully bring inflation down. The long end of the yield curve is not directly controlled by the Fed. It's controlled by bond investors. Through their buying and selling, they drive bond prices up or down. And so when you see the long end of the yield curve have lower rates, that's bond investors predicting that in the future, rates will be lower than they are now. So in the short run, the short end of the curve is telling us, yeah, the Fed's pushing up short-term interest rates. There's nothing anybody can do about that. But the long end of the curve being lower is saying bond investors believe, and collectively bond investors are pretty good prognosticators or forecasters. The long end of the curve is telling us, yeah, but the market and bond investors in general believe that in the future, rates are going to be lower, which also implies that inflation is going to be lower and so forth.
So that concludes the comments we had on performance and what we've been seeing in financial markets. We're going to pivot over to a discussion about the economy. And we start with a fun little image that we found on the cover of this week's edition of The Economist. So the title, Riding High, you can see the horse here with the elongated legs, cowboy sitting atop of it. And the subheading is The Lessons of America's Astonishing Economy. So Dave and I were having some fun, discussing this article yesterday. Just to share a couple of the stats that were cited within the piece. In 1990, the U.S. accounted for a quarter of the world's gross domestic product. Total economic output, 25% of it came from the U.S. What the article pointed out was some 33 years later, that's still true, even with the Chinese economy growing into a global superpower, other nations growing and developing. The U.S. still is holding on to that 25% share of total economic output across the world, which is impressive. In terms of its share of the G7, so 7 of the largest, most prominent nations around the world, in 1990, the U.S.'s share of GDP for the G7, 40%. Presently, it's 58%. So we account for more output relative to 7 of the most prominent nations around the world. And in terms of, actual labor capital, human beings working and contributing within the economy, there are 30% more workers in the U.S. now relative to in 1990, 30%, compared to a 10% growth in active participants in the labor market in Europe or Japan. So triple the growth in workers, laborers, contributors to the economy over the past 30 years relative to European nations and Japan. And so we thought that was an interesting place to start. Of course, we had our poll question, trying to take your temperature to see what you all were thinking about how things were unfolding in the economy. And given that so many of the comments in this particular article focused on the labor market, we wanted to start our comments around the economy in that space. And I'll say here in this particular space as well, we are going to talk about inflation and interest rates. But we want to remind our viewers and our listeners, the Federal Reserve has a dual mandate: stable prices, and that's the inflation story, and we are going to get to that, full employment, and they work in concert. And so we'll spend some time talking about the employment side of that mandate before diving into the inflation aspect. So we'll begin with a chart. And rather than using 1990 as a point of comparison, for our analysis here, we're going to be talking to you about the last 15 years or so. So what you're seeing on this chart in orange is real GDP, inflation-adjusted gross domestic product for the U.S., so a measure of economic output, starting at the beginning of 2007 and stretching through the end of 2019. Well, why did we pick this period? It coincides with the second most recent recession in our nation's history, and that's the Great Recession that spanned from 2007 to parts of 2009, indicated by the gray bar here. You have economic output over that period, taking a dip throughout the recession and then recovering thereafter in orange, and then unemployment measured by the purple line. And so you can see that during the recession, unemployment skyrocketed all the way up past around 10%, and then subsequently decreased all the way to 3.6% at the end of 2019. So keep this image kind of in your mind and note that over this period, inclusive of the recession, that real GDP growth was positive, call it 1.7%. Now we'll compare that against same kind of chart, but you're looking at the most recent recession. So from the end of 2019, we pick up right where the previous chart left off, and then stretching into the end of the first quarter of 2023. Same components of the chart, by the way. In orange, GDP, inflation adjusted, running across the period of time we're measuring. And then unemployment, likewise, skyrocketing at the beginning of the COVID recession, all the way up nearly 15%. And then coming all the way down to where we are at present, 3.5%, which is the lowest that unemployment has been since the 60s. What we can also see here is for this recession, inflation adjusted GDP growth, just as good. It was 1.69% on the previous slide, 1.65% here. What's fascinating to note is if we continue through, this particular chart is showing you economic output again in orange. That's your inflation adjusted GDP. And here's your decrease in the unemployment rate. Again, this is going back to the period following the Great Recession. So we've taken the recession years out of this chart. And we're just looking at the recovery, just the good times kind of between recessions. And we'll note that GDP growth, if you take out the recession years, adjusted for inflation, when inflation, by the way, was nothing. You know, for this particular decade, inflation, I think, was averaging around 1%, maybe lower. Your inflation adjusted growth was at 2.27%, 2.3%. Well, how have we been doing since the recovery began for this particular recession? A full percentage point per year better. So what we can say in sum is throughout the recovery from the COVID meltdown and the COVID recession, the U.S. economy, while dealing with the highest inflation rate we've seen since the 80s, has been growing at an annual rate that is 1% higher per year than the U.S. economy was growing coming out of the last recession, which coincided with the longest running bull market in the stocks, or in the stock market, I should say, that we've seen in U.S. history. So from what we can measure, the economy is performing incredibly well. You can see where, unemployment rate at 3.5%, again, the lowest it's been, in 5 decades or so. And an economy that's growing, at a rate that's 40% faster than the rate it was growing coming out of the past recession. So we've got more to say here, but I'll pause. Dave, any thoughts to add here before we continue?
Not really, other than that the last 3 charts really show the inverse relationship between economic output and employment. And it shows you that, how important employment is. It's part of what made the U.S. economy so astonishing is that, our workforce is 30% bigger than it was back in 1990. And that is part of what's contributed to the growth in the economic growth. That's why, honestly, if you're not going to have, if you're not going to have growing fertility, you're not going to have more babies, you need to have more immigration if you want to keep your economy growing at a decent rate. It's one of the advantages the U.S. has traditionally had. Immigration's been kind of a hot button issue for the last few years. I'm hoping we can get past that and go back to having a sort of a reasonable, robust level of immigration from around the world in the future, because it has only served us as a country and as an economy. Part of the reason that Japan has been in some ways in economic decline is because it's an aging population. They have very little immigration, and they also have a low fertility rate. They're not replacing themselves with new babies. And to some degree, Europe has experienced that as well. And of course, China's population is shrinking. India will shortly have a larger population than China. All of these things are economic negatives. And fertility in the US has also been shrinking, maybe not quite as fast as Japan or China or even Europe, but it has been declining. And the thing that's rescued us in recent decades, over the last 20, 30 years, is the fact that we had more immigration in those countries. We really need to focus on immigration as a positive public good and find a rational way to get it fixed. And I'll leave it at that.
Yeah, and I mean, just agreeing with you, we shared the stat at the beginning. The U.S. has 30% more workers than we did at the past, or in 1990, and with more working capital, with more people contributing to as labor capital, then you have more economic output. So we go to the next slide, and this is my favorite slide. It is also our busiest chart, and so we're gonna park it here for just a few minutes and really talk about what we're seeing here and what's going on.
I'm going to interrupt just by saying I've outed Yusuf before. I'll probably out him on every webinar, but he is the world's biggest chart geek. He has a subscription to a thing called Y Charts. And I think on a daily basis, he is there conjuring new illustrations of what's going on in the macroeconomy in the US and around the world. And you're seeing just a few examples today.
It would not be untrue to say that I think and dream in chart form. But without further ado, we'll dive into this thing. In purple and orange, we're tracking the same factors that we were looking at on the previous few slides. So again, in orange, inflation-adjusted GDP. And you can see that growing over the period we selected here from the beginning of 2021 through the end of the first quarter of 2023. Here's GDP, economic output increasing, through just about every period. Slight dip here at the beginning of 22, but the trend line highly positive. In purple, unemployment. And so that rate coming down over the same period, down to the 3.5% rate that we mentioned on the previous slide. So the new entrants to the picture here, number one, CPI, Consumer Price Index, headline measure of inflation that's put out by the Bureau of Labor Statistics. You can see peak inflation last summer, about July 2022. And then for any of our respondents who said inflation was trending down, you got that right. 9 straight readings of inflation coming down from where it peaked, 9%, just a shade below 5% as of the most recent reading. And then finally, in green, we have the federal funds rate, the interest rate that the Federal Reserve manipulates, and that they've been raising, as you can see, kind of the stair-step increases over the past year or so. So what story is this chart telling? This is the chart that at least says the argument for a soft landing has not yet been disproved. When we talk about soft landing, it's the outcome the Fed is trying to engineer by way of manipulating interest rates to bring the inflation rate down without killing jobs, without destroying the economy. So far, so good. So let's go back to each of the lines here. You can see that, the federal funds rate, the Fed started raising interest rates, in early 2022. If we just focus on the green line and then look at overall economic output, there was a dip. But since, about the middle of last year, the growth in output, again, adjusted for inflation, has taken us to a new high. Furthermore, we go back to the rate here, the federal funds rate. It's coming up, and the desired effect, by the way, is occurring. Inflation is coming down, and avoiding this line, the purple line, which is measuring unemployment. What we would not want to see here is for this line to be trending upward, and it's not. Over this entire period, the unemployment rate has been trending down. So again, the Fed thus far has been able to bring inflation down without killing economic output and without killing jobs. Now, an inflation rate of 5% is not an inflation rate of 2%, which is the goal, the the relative goal that the Fed tries to keep inflation around. 5% is certainly better than 9%, and things are absolutely trending in the right direction. So the story isn't over, but so far it's not a horror story. It's one that has some encouraging bits, and one that we think is trending in the right direction. So Dave, our next slide is pivoting to a more direct focus on inflation and interest rates. Any comments here before we move forward?
I guess the only thing I would add is that I know that most of you who have joined us today are avid consumers of news on a daily basis, and so you've undoubtedly seen that there have been some headlines about a growing number of prominent economists suggesting that the odds of a recession are higher. They're not saying a recession is going to happen, but they're putting the odds of a recession a little higher. But if you burrow down into the details, you find that even those economists who are suggesting the odds of a recession occurring later this year have increased. They're all saying if it happens, their expectations are that it would be mild and it would be short. Now, the one thing I'll add, we do all these statistics and we delve into the economics of what's going on, but the other reality is, and you all know that it's also a fundamental part of our worldview, prediction is hard. And there's a lot of evidence that economists are every bit as bad at predicting the future as everybody else. So that's one of those things where you shouldn't necessarily put too much weight in anyone's predictions about the future, including ours, when you get us to make a prediction. But anyway, carry on.
So, back to the Fed's dual mandate. Again, full employment. We just spent a few slides talking about that, so we'll pivot away from that and talk about inflation, interest rates, because it starts to segue into a couple of the other topics that we want to make sure we cover today. Another chart here, 4 components, but this time they're all focused on either interest rates. So again, there's the federal funds rate in green, and then 3 different measures of inflation. Now in purple, we have CPI, Consumer Price Index. And so again, trending in the right direction at 4.99% as of the most recent reading. In blue, we have the PCE, Personal Consumption and Expenditures Index, another measure of inflation that the Fed looks at when determining whether or not they're going to raise rates, also trending in the right direction. The last several readings have all been, moving downward. And that reading came out at 5%. What's interesting is the orange line, which depicts core CPI. So what it takes out from the Consumer Price Index, food prices and energy prices, which are notoriously volatile. And sees, okay, if we strip away the noisiest or noisier aspects of this measure, what does inflation look like? Well, interestingly, that core CPI, you can see here over the past couple of months, has kind of flattened out and increased a little bit. So in terms of outlook, one of the things to be mindful of, stock market's performing well. The job market is performing well. Unemployment is at an incredibly low rate. And, there may be some stickiness to some components of inflation, which would support the belief that perhaps the Fed is not yet done raising rates. I don't know that we're going to see, 0.75% rate hikes like we were seeing last year. I think those are behind us. But we might not be done with the 0.25 point raises here for another couple meetings. So, the headline here really, inflation moving in the right direction, but not quite behind us yet. And so we expect that you'll continue to hear more and more commentary, and that the expectation would be that the Fed will either continue to raise rates slightly incrementally, with no expectation that rates would be coming down anytime in the immediate future. We'll pivot, but it's not a hard pivot. Talking about banks, the recent banking scare, and the reason I'm saying it's not a hard pivot is because interest rates have a lot to do with the story of what happened to Silicon Valley Bank and First Republic Bank. So you can throw Signature Bank in there as well. What we want to say about those particular banks, first of all, is to put their size relative to the banking industry at large in perspective. You can see here at the bottom, if you chart the size of the biggest banks in the US, you see the big four: Chase, Bank of America, Citi, Wells Fargo, in terms of total assets, in the trillions. Okay. When you look at Silicon Valley Bank and First Republic, down here at 210 billion, 200 billion each, give or take, not nothing, but a billion relative to a trillion, it's not even really in the same arena. And so that's not to diminish the significance of a bank failing. That's big news. But when we put it into perspective, for us, when we think about, the reasons why those two particular banks were under strain, and we'll make those comments here in just a moment. When we think about the size of those banks relative to the banks, the bigger picture, it puts things into the proper perspective and helps kind of ease, some concerns. In terms of Silicon Valley Bank and First Republic, both had a high concentration of exposure to tech companies, which, if you'll recall, had a really bad year in 2022. And so that led to a number of them making withdrawals from their accounts with these two respective banks. A lot of those tech companies were also big investors in crypto, which also had a really rough 2022, which leads to even further need to take money out of accounts that they might have had with either of those two banks. When you couple that with the fact that interest rates are on the rise, and so that makes, it makes it harder for banks to make money because loans that they're giving out are more expensive. Fewer people are taking loans when the interest rates are higher. Well, the banks got more money going out as a result of more redemptions and fewer dollars coming in as a result of higher interest rates, making the loans they're trying to get out there more expensive. Well, it's a recipe for disaster. And that's exactly what we saw with a couple of these banks here at the early part of this year. We firmly believe that those factors were localized. We're not really identifying any source we're not really identifying a need to worry. We don't think that we're seeing any form of contagion that's going to spread to the broader banking industry. But wanted to make a couple comments about what we had seen in the earlier part of this year. We'll pivot here and talk a bit about how our clients' assets are protected. We were getting a lot of questions about that, but I want to pause here. Dave, anything you'd add just in terms of comments about the banking scare?
Well, I will say that we took it very seriously. The weekend that, if you really followed it closely, Silicon Valley Bank declared insolvency on a Friday, and we spent the weekend sort of in all hands on deck mode, figuring out if there, what kind of, honestly, we went through our client list and figured out who's got money there, which some people did, who has money at First Republic Bank or any of the other regional banks that are stressed. What's our message going to be? What's our advice going to be? And fortunately, those with any money at Silicon Valley Bank, even if it was an uninsured deposit, got rescued. And for the rest of it, our primary advice was just pay attention to the FDIC limits. I will say Elisa and I have accounts at First Republic Bank, which is at the bottom of this chart. And I'm not afraid to have money there. But we're not putting more than the FDIC limits in our accounts. So, we're not being afraid, but we're being prudent. And this is what we're recommending for all of you is there's no need for fear, but be prudent. And there are ways to do that.
Yeah, thanks, Dave. It's a perfect segue to talk about asset protection. And I'll note here, and we can share this as a follow-up along with a recording of the webinar. We did put a piece out recently, just summarizing some of the things that I'm going to mention here, actually in greater detail than what I'll do in this particular space. Just how our clients' assets are protected. The image here is illustrating that because Schwab uses two banks for clients' assets, any of our clients' accounts at Charles Schwab, each individual account holder gets their normal $250,000 FDIC limit, or as a joint account, 2 account holders would have $500,000. Because there's a secondary bank that Schwab uses, there's an additional layer of the same amount of protection. So you can see on the image here, $250,000 from the first bank, $250,000 from the second bank per account holder. So, strong protection in terms of FDIC insurance on any cash positions in our clients' accounts at Charles Schwab. And then above and beyond that, there are other forms of protection. There's the Consumer Protection Rule, which mandates that broker-dealers, so Charles Schwab, does not commingle clients' assets, so your money is not mixed in with Schwab's money. So if, heaven forbid, something were to happen to Schwab, that would be bad news for Schwab, but not bad news for your particular assets. Not that we have any reason to believe that there's anything to worry about for Charles Schwab and company. But just sharing that, that's yet another way that your assets are protected. And there are more pieces that are included in the asset protection piece that we put together. We'd recommend that you visit that when you have a moment. And again, we'll recirculate that as a follow-up from today's conversation. And so that brings us to the end. Our outlook for the next quarter and the rest of the year, and then we'll maybe make some space for any questions that have come in. The Fed gets together in a couple of weeks, and it's expected that they will raise rates again. We've bolded here, the range of expectations, somewhere between 1/4 point and 1/2 percentage point. Current expectations, based on all the factors that we've discussed, are 1/4 percentage point. What will be interesting to see is, again, how the inflation story continues to unfold, whether or not we continue to see decreases in those inflation rates, and then what the Fed does. So we get a 6-week break between May and the June meeting, and then we have the June and July meetings. And if the trends continue to be encouraging, it might be fascinating to observe the Fed decide and to see whether or not they stop raising rates. I don't know that we expect rates to come down at any point this year, but at the point at which the Fed stops increasing the interest rates, that's a really positive indicator. And so we'll be on the lookout for whether or not that occurs sometime this summer. And then, of course, we've posted the remaining meetings that the Fed will have throughout the year. But that's what we're watching: interest rates and inflation, of course, with an eye on the unemployment rate as well. We know the Fed is watching the unemployment rate and wants to make sure that we're maintaining full employment as they continue to tighten things on the interest rate side. And it's kind of a stay tuned, and we'll see month by month, quarter by quarter, how things unfold. Dave, final thoughts to bring us home?
Yeah, I mean, I just would, honestly, I would just reemphasize what you said, is that the odds are good that there'll be another incremental increase in the next round, and the round coming up in a few weeks. But even when the Fed hits the pause button, as you said, Yusuf, they're likely to keep rates where they are for a while. Now, if you're really happy that your money market fund and CDs are yielding more, then that makes you happy to hear that the rates might stay there for a little while. But the Fed has become very cautious, and I think they feel like they got burned a little bit when they back in 2021, when they said, this spike in inflation is due to temporary factors, and they feel like they got caught a little behind the curve. Now, honestly, we think the emerging evidence is that they were right, that they were, to a not trivial degree, temporary factors, but we'll see how sticky it is. You pointed out that the core CPI was leveling off, maybe looking a little sticky. This is one of those things where only time will tell, but we are, as you said, Yusuf, cautiously optimistic about the course through the rest of the year.
So we have a related question there, and Dave, I think in your last sentence, your final sentence there, you answered it, because it starts with impossible question. how many months or years before inflation gets down to the range of 3% or so? And you said only time will tell, Dave. So any other thoughts in addition to that?
I mean, I think that here's the thing. The Fed's really clear that it's shooting for 2%. It would probably accept 3% at this point. So in a sense, it's going to happen sooner rather than later because the Fed's going to make it happen. And we just hope the Fed makes it happen without creating too much of a recession. But I do think we can count on the Fed to continue to raise interest rates and to keep them relatively high until we see inflation rates coming down to that level. So because the Fed has a lever, the lever is not perfectly predictable. They keep pulling on it. And, 9 times out of 10, they overshoot the mark and we get a recession. But I would be amazed if we were not down below 3% by early next year.
So one other question so far that's come in, and feel free if you have questions, type them in the chat or the Q&A panel, but one that came up just a while ago and wanted to come back to it is, Dave, you mentioned how India's population is going to surpass China's population. And someone's just asking, what are your thoughts on that? Any additional thoughts you have on that happening?
Well, so what I think, first of all, as we discussed earlier, population growth is actually a big input to economic growth. Now, there are other factors, including productivity of workers. The higher their productivity, the more each worker contributes to economic growth. But more workers, just by definition, more workers equals a bigger economy. And so I think that as China's population continues to shrink, and as India's population continues to rise, India is eventually going to probably become the 3rd largest economy in the world, and maybe even at some point eclipse China. But how, without that kind of a ranking, which is a little bit of an artificial thing to focus on, there's kind of like a, get your fingers under your under your suspenders and brag. The reality is that India is a rising power, and it's a rising economy. And notwithstanding some of the authoritarian tendencies of Modi, its leader, it is nominally a democracy. It's the most populous democracy on the face of the earth. And so we might think it's an imperfect democracy. Sometimes it looks like the US is a bit of an imperfect democracy. But I like seeing the rise of another democratic power in the world. China is communist and authoritarian, and it's very much a command and control economy still. Seeing the rise of a democratic power, I think it can only be good for the cause of freedom and democracy worldwide.
Great. So we have 2 more quick ones that came in here, both kind of related to the last 2 questions, but just any thoughts on the outlook for international markets this quarter that we're in now and beyond?
You want to take the lead on that, Yusuf?
Yeah, valuations still look good. Relative to the U.S. So, stocks in the U.S. are still more expensive than stocks, scattered around the world. And so the fact that they're outperforming U.S. stocks and still valued more cheaply is very, very encouraging. So we'll keep our eyes on that. But it's been an encouraging trend that we've been observing for a while now.
Yeah, that's a good point. We don't think that trend has come to an end. It's one of the reasons why we invest globally. We have a lot of questions, back in 2018, 2019, when the US was dominating the rest of the world. We got a lot of questions about that. Why don't we just put it all in the US? Well, over the last couple of years, the markets outside the US have been doing better than the US, and that's why. We can't predict when they're going to change leadership, but based on the last 50 years, we know that inevitably they will trade leadership from time to time. And so true diversification requires us to be invested both in the US and outside the US. But I agree with Yusuf. I think because of where valuations are, I think this current trend may have legs.
Great. All right. So just being mindful of time, there's one more question that came in a few minutes ago. If you have any more questions, please type them in and we'll get back to you via email after this. But one more, just back to inflation, Dave, on what you were talking about. You know, the Fed has its mandate. They're going to try to get inflation back to where they'd like to see it. 2%, would be happy with 3%. Just in terms of your, I don't know if I want to call it a prediction, but your musing that you'd be surprised if inflation wasn't significantly lower come next year. The question is there any political component to that prediction of where inflation may head?
You know, that's a great question. And one of the things we've seen for the last 20 or 30 years is that the Fed has truly operated in an independent fashion, as was always intended, to be separate from politics, to be making decisions solely based on its dual mandate that Yusuf was talking about, which is to say low prices and high employment. And I, you know, under Chairman Jay Powell, I continue to have a lot of faith that the Fed will operate independently, and that the Fed will not do something to rig an election, like let inflation run so that we don't run it, so in order to avoid creating a recession or anything like that. I think the Fed will follow its mandates, and will do so without prejudice, and without favor and without prejudice. That's our general assessment here at Yesky Buoy, and we see no reason to change it.
Wonderful. Great. Well, there are a couple more questions that have come in, and as I promised, we will answer those via email. I've got them down in our notes. And so I think we're good to wrap up.
Well, thank you everyone for joining us. You know, we all love, I mean, Yusuf and I love to talk about this stuff. We don't have you to talk to, we're talking to each other about it all the time. So it's kind of nice to open up the doors and be public once in a while. So we're glad you joined us. And, you know, and if you know anyone who you think might find the topic interesting, it will be recorded or has been recorded. So please share the link when you get it. And as Lauren said, please don't hesitate to call us or email us if you have further follow-up questions. And we just look forward to the next time we see you.